Hello and welcome to the business structures presentation. And in this video, we are going to talk about advanced structures. Now, when I'm talking about advanced structures, we're really talking about, some of the most common ones and then putting multiple different structures together to get the best of, the worlds of different structures. So we'll go into it, overview, and then we'll talk about the structures, and we'll go from an owner level, and then we'll go into the multiple structures, and then just a couple of classic structures that generally provide the best bang for your buck in relation to everything that you want to achieve. Ultimately, the disclaimer again: informational purposes only. Please speak to a professional accountant in relation to your specific circumstances before choosing a structure to go down. So in our overview, like previously, we've just considered structures as a one-off. So, we've spoken about, a sole trader and only having your business in the sole trader. We've spoken about, a partnership, and we've touched on, at the partner level. The same with a company. We've spoken about, what's the implications of, having your business in a company. And we've also spoken about, the implications of, having, the business within a trust as well. But we want to start getting into, okay, well, what happens if we can start combining, a couple of these different structures together, and what type of result do we get, and what are the benefits that we would get with that? And then, finally, we'll just have a look at some of the classic structures that that are quite common. So from these one-off structures, as I've just mentioned, we've been at the business level. Now what we really want to do is we want to go down into the owner level and look at, your structure as a whole, your business structure as a whole, including your business level and the owner level, because, it's one thing to have, tax borne on yourself at a business level, but if we really want to, lower your overall, tax position or cash flow position or asset protection level, we need to look at all entities. We need to take a holistic approach in relation to, you and your specific circumstances. So with multiple structures, as a sole trader, we cannot have multiple structures. The business, is the individual, and all tax is paid by the individual at their marginal tax rates. So we can disregard, sole traders as having multiple structures. However, we can, as a partnership, have multiple structures, and all tax is paid by partners at the partnership level. Now, the question now is, well, who should we have as the partnership partners? So all tax is paid by the owner at the partner level. So a partner can be an individual, it can be a company, or it can be a trust. The benefits we have with, this is we have a company, we have a set rate. An individual, we have a marginal rate. A trust, we can have the flexibility of whoever we want to pay the profits from that partnership, or actually have it as a loss in that case. So we've got a bit of flexibility, and the same thing with the partnership is they had that thing called joint and several liability. Now, if it's joint and several liability at an individual level, that means the individuals can become personally liable for the actions of the partnership. But if we go back to, our company example, a company and a trust, can also have limited liability in relation to the share capital of the company, or, the relationship the trust has with its trustee. So we could actually get the benefit of a business partnership, but also have a company in place at the owner level to then provide us with protection, asset protection, liability protection, and also tax and cash flow protection as well. So we do have this option of, the partnership on its own is somewhat not of an attractive structure. But now that we've actually got a layer underneath it, this could actually become a viable structure for someone moving forward. Obviously, it does have its drawbacks, as we've discussed previously. You cannot add partners. If you want to add or remove partners, very difficult to do. So those things need to be weighed up moving forward. But we can have get the benefits of the partnership, but we can also limit the negatives of that partnership by actually incorporating something at their partner level with a different structure. So this just changes how we look at partnerships. The same can be said for a trust. All for a trust, all tax is paid by the beneficiary. Now, who can be a beneficiary now? Well, we can have an individual as a beneficiary, and that's who we had in our example when we spoke about trusts. Where we could bring, if we had multiple beneficiaries, adult beneficiaries with nil income, we could bring that tax down from 120,000 and pay no tax on that at all. But we can also get the benefit of a company and their set tax rate too. So if you've got a trust that earns a lot of profit, we can't keep paying an individual money because we get trapped in their marginal tax rate. And let's just say for this financial year, if you're an individual or a couple that if your trust earns over $360,000, or actually even 90,000, if your trust earns over $90,000 in profit, capping your overall tax liability with the use of an individual and company can actually be beneficial. And I've got an example of this a little bit later to see how that can actually work. But knowing if your business is in a trust, who the individuals can be, the beneficiaries can actually be quite handy. So, combining a trust and a company can actually be really important. The same on the flip side, the company, we get, the benefits here. We've got flat tax rates, but, one of the negatives is we don't get access to the marginal tax-free thresholds of individuals. But if we actually have, a trust as an owner, we can get the flat tax rate of the company, but then we can also use that to our advantage by having trust as a shareholder, who then we can distribute to individuals. Or we could just have individuals as the owners, or you could have even another company as an owner as well. So, who owns the company is a really important consideration when looking at your group as a whole, because it does have tax implications for it. So, we get the benefit of the dividends, the flat tax rate, but then, we can also provide flexibility with who the owners are and what tax outcome that we're wanting to achieve at the end of the day. Really, that's, the thing with the multiple structures, the benefits is, we really want to get the best of both worlds. As mentioned, we want to be able to access the tax-free thresholds as individuals, but we also want to cap the tax that we ultimately want to pay through the use of, companies. I think I spelled that wrong. So, human. So we want to access the tax rates, of companies as well. Using trusts, we want to get the benefits of flexibility. So, we're not only wanting to get the best tax outcomes, from individuals and from companies, but we want to have the flexibility and the decision of who that goes to. We want to also have, limited liability as well, like with that partnership level. We want to limit, the negatives of those things as well. And by using some multiple structures differently, we can actually achieve that. So in relation to the most common structures, look, the best structures, no matter what, have a company and a trust involved in it. at some level. On the left hand side here, we've got the business is run through a company, but we have a trust at the owner level, and then we can access the individual beneficiaries. We want to be able to access a company for cap tax rates, asset protection, growing the business. This structure is more for a company that wants to grow. And then we've got the flexibility of the trust being the owner. We can distribute out to beneficiaries. With the business being the company, we can also add new partners. If we want to, access new capital, grow, get new partners on board, we can actually go down and use that. This is different from, the business being a trust. Yes, we could have a unit trust that can have that benefit. But if we're talking about, the most common, family trust or discretionary trust, we're probably looking at a business here that, is not going to grow endlessly. There is a cap. It's more maybe of a lifestyle type business or a family succession planning type business, where lots of profit is earned, but we also want a company there to cap our tax rates. And we also want to be able to access the individual beneficiaries as well. So each structure, this is why it's important to understand, what your objectives are and what your sale, outcome is, because, you could have the two same structures here. You get the same outcome no matter what, because we're hitting it. We've got a company, we've got the cap tax, we've got the owners, we've got the trust, we've got the beneficiaries, they're all the same here, but there are completely different outcomes in relation to retaining capital and growing, and then adding people as well. So this is why, your overall objectives are important, because one person's circumstance is completely different to the other, and one might be more suited to a trust setup, or the other, more suited to a company setup. And let's just go back to this tax example. Now, this is the original tax example that that we've been going through the structures series at the moment. So nothing is new there, but let's change it up. So we know our best outcome through all of this is a partnership of nearly just under $20,000, and that's just a partnership, split between two individuals. And it's probably more centered around a husband and wife type business, right there, not an unrelated parties business. So let's just go to one of the common examples. So we're going to the company is the business. So if I just go back up a couple, what we're really concentrating on is this structure right here. This is the structure that we're talking about, that we're thinking about in our example right now. So here we are. Company is a business. So this company, has gone down. We've got those two individuals. Let's just think about this as the husband and wife business, so we can compare this to the partnership example. So we've got a business. What we want to do is we want to access the tax-free thresholds for the individuals. That's our main concern. So right now we've got $24,000 each that we can get tax-free. Right here you can see zero tax. So $48,000, zero tax. So now we've got what's been in the company, what we've retained in the company. We know that there's a cap tax rate of that, and that's the tax that we pay. So we already can see right now, by changing our structure up, we're $1,000 better off. We're also in a company for a business. So if we wanted to add partners along the way to grow, to retain funds, that's all happening within our structure at the moment compared to a partnership. The partnership also, we don't have that. We've got limited liability in this company compared to the partnership. So we're $1,000 better off for tax and cash flow purposes, but we're also, we've negated some of those negatives, and we've got the best of both worlds from tax and flexibility. So the way that works is obviously the company pays a distribution, a dividend to the to the trust, and then the trust then distributes to the beneficiaries. That's how we get this result in this example. So if I go to the next page, let's see if we can lower our tax a little bit more, and we can. So we've just changed up, our distribution to everything, and the tax rates. We've manipulated the tax rates of the individual a little bit more. So, same $120,000, sitting right here. If we retain 30,000 in a company, that's just under $8,000 in tax the company would pay. But what we've done here is we've distributed, instead of 48,000, we've distributed 90,000 to the two individual beneficiaries, which has given us total tax there. So now we've got 18. So now we've nearly lowered by our total tax outlay by $2,000 by just changing this structure around a little bit more. So this is the power of putting multiple different structures together, and we're not even talking about some of the other tax planning things that could happen if your business, your group is a bit large with soaking up losses in other entities and distributing to other entities. They've got different tax profiles. This is quite a simple structure example when we have a company as the business and a trust as the owner. One of the other ones, and if I just want to maybe just quickly come back and just highlight, the best structures, for people that are thinking about running, a business, generally have a company and trust. So, the initial setup fees and the ongoing costs, that just needs to be outweighed by the tax saving that you're already going to get. So, from our example, if you just wanted to go down the sole trader path, 31,000, we can already see by doing a little bit of structuring, we've already saved, between $12,000 to $14,000. So, this is, the power of, going through and actually setting up a structure that actually works in your favor and has the cash flow, implications that are positive for you and for the growth of your business and for your, wealth accumulation as well. One of the other common structures, and this is more of an asset protecting type structure, which is quite common, where we have a trading business, can be a company or a trust, but generally what you would see is it's a company, and then off to the side, and this is why it's across to the side, we have an asset holding entity. So if I can give you an example, we are we're an earth moving business. So we have, our assets are trucks, excavators, diggers. We've got a lot of high cost assets that we use for our business. So, that's why we've got this structure over here. So, the trading goes on in this company into the trading business. So that's where all the income, that's where the expenses, salary, wages, superannuation, taxes are paid and everything in that, but it doesn't hold assets. Now, the reason it doesn't hold assets is if case something happens to this company, that it gets sued, it hit a power line, everything just went completely belly up. The assets of that business are actually owned over here by this asset holding or service entity. So, the trucks that they have, the diggers that they've got, the excavators that they've got, those things are actually somewhat protected. And because we can use the corporate veil and some of the things that are designed around a company, we actually still get to keep our assets at the end of the day. So we could potentially, start up another business and then use these assets to continue going. So, it also, you do see it in sometimes service entities when you've got intellectual property. You might have the trading business right here, sales, income, but there might be an agreement across to this company where there's, intellectual property. So you could see some things like if you've got a franchise of business, you might have over in this entity is the franchise or, intellectual property. And then over here is, the company that actually, does the work. Like if I give you an example, This could be McDonald's headquarters that has the processes and procedures, the intellectual property all in here. But then this is the McDonald's business that is privately owned, that's off the side. So then they pay a fee across to this entity as well. So that's a bit more of an extreme example, and a bit more higher level when we're talking about franchising. But at the end of the day, if this is in your particular structure, they can have common ownership. So you might have a family trust or an investment trust that owns both of these 100%, or in a different ownership percentage. So this is actually really one, definitely with assets or intellectual property. You can even have employees. It can be an administration entity as well. So it's just a lot to protect the business and protect the assets, and keep them separate. So if one falls down, the other, and all the cards aren't going to come falling down. So that's it for this video. So I just wanted to highlight the power of being able to combine multiple structures to get the result that you want overall, which is somewhat lower tax bills, and also more cash in your business, and also limiting your liability as well. So in our next video in this business structures series, we're going to talk about paying yourself as an owner, because we haven't really spoken about that at the minute. And I've broken these into 3 separate videos. So in this first one, we're going to talk about the sole traders and partnerships. Next, we're going to talk about trusts. And then finally, we're going to talk about companies to finish off this series. So we'll see you in the next video.